As the European Central Bank prepares to take the stage for its July policy meeting, a high-stakes performance lies ahead. The continent's monetary minders must navigate a delicate economic ballet, fine-tuning interest rates in a bid to rein in stubborn inflation without overly constricting the Eurozone's fragile recovery. President Christine Lagarde will assume center stage on Thursday, all eyes upon her as she delivers the ECB's latest aria on borrowing costs. The overture has already been set. According to the consensus forecast of all 55 economists surveyed by Bloomberg, the deposit rate will hold at 3.75%, its level since the opening salvo of a quarter-point hike in June. Yet this upcoming performance represents merely the opening movement in a longer symphony. The true anticipation builds for September's encore, when the wise eminences of Frankfurt are expected to deliver a second quarter-point reduction. By then, 2 additional monthly inflation registries will have been scored, alongside complementary accounts of wage and productivity trends. Investors in the ample arena of monetary policy will attune their ears closely to any suggestive notes Lagarde may trill about a potential resumption of easing measures in the Eurozone come autumn. Her choreography following the 2:15 p.m. curtain call will be as crucial as the policy announcement itself at 2:45 p.m. The bookmakers' odds suggest 2 more quarter-point cuts loom this year, one in September, one more in December's finals. A minority contingent foresees just a single downward adjustment, while market pricing solidly pencils in one easing and leans decidedly toward another. The overseers have previously intimated that July's performance amounts chiefly to an intermission, a respite to reappraise unfolding economic cadences. Chief economist Philip Lane has proclaimed the debate will focus on the core financial themes. He conceded, however, that the data arriving for this meeting shed mere fragmentary light on the outstanding queries. Lagarde herself has sparked speculation of quarterly rate reductions in lockstep with the arrival of updated forecasts. "We need a lot of data," she declared following the ECB's annual Sintra retreat in Portugal. "I'm not sure that we are getting those data at every single monetary policy governing council meeting that we have." For the elusive 2% inflation target to manifest its choreographed return, the central bank strategy pivots on an intricate interplay of factors: moderating wage growth, thinning profit margins, and amplified productivity. A complexity that may well defy the ballet master's best-laid schemes. Domestic price pressures, in particular, continue their stubborn waltz. Robust labor markets and buoyant service demand underpin these persistent upward strains. In Germany, the Eurozone's lead protagonist, unions have proved resoundingly successful in securing raises to counter past inflation's economic decrescendo. Evidence of these payroll swan songs across the second quarter will arrive in prelude to the ECB's September performance, along with freshly revised projections for the collective 20-nation economic and inflation narratives. Some recent foreshadowings, however, signal potential turbulence in the approaching X. Recessionary drafts have buffeted the manufacturing scene, services have slackened their once buoyant tempo, and escalating uncertainty has dampened economic confidence like a sudden hush falling over the house. Even before the harrowing attempted assassination of former Presidentissimo Donald Trump, analysts had cast the looming November elections as the principal villain imperiling the Eurozone recovery. Tragically transcending mere palace intrigue, the unthinkable incident appears to have bolstered Trump's odds of an audacious White House return, particularly amid swelling calls for the incumbent Democrat to yield the stage in favor of a more sprightly leading player. Nearer to home, additional perils shadow the footlights. The abrupt curtain fall on France's snap elections initially stoked fears of either a far-left or far-right government seizing the national plot. Instead, a parliament chronically afflicted by gridlock now seems fated to grapple with that republic's pressing fiscal afflictions. While these episodes have steadied market nerves, the seditious backstory harkens to the Eurozone's haunted debt crisis a decade prior, prompting trepidation over Italy's own parlous finances now gliding into the critical limelight. The impresarios of monetary policy insist recent volatility has warranted no disorderly overreaction. Thus far defying murmurs their backstage outright monetary transactions program may require reactivation as an emergency understudy. They've nonetheless decried the star turn of German Finance Minister Christian Lindner, who dared question that legal instrument's very prima facie legitimacy. Yet fresh bedlam could still upend the performance should profligate governments fail to corral gaping deficits or bungle attempts to raise the productivity bar. The central bank's choreography may well face its greatest challenge in delivering sufficient monetary restraint to tame inflationary furies, while avoiding overly draconian measures that could curtail Europe's economic renaissance too abruptly. For the ECB's principles, walking that tightrope between financial temperance and growth remains the singular eminence they must transcend in this high-stakes season. All eyes will observe whether Lagarde and her coterie can strike that improbable balance with the impeccable grace of master artistes. A watching world anxiously awaits the opening bars.